We're here live from the Motilal Oswal conference. The markets are still under pressure, so the Sensex is down about 240 points and the Nifty as well is sliding as we speak. But now we have two gentlemen who join in from the Motilal Oswal conference. With us is Gautam who spearheads the Focus 35 fund, and we have Taher Badshah. He's a regular on our channel in our morning shows, but now he's here with us. And of course our very own Nimesh Shah is also here. So gentlemen, afternoon to all of you. Taher, I want to start off with you. You were telling us, the returns from your fund, which is about 60% CAGR on the Focus 30 fund since its inception and about 27 to 30% on the Focus 25 fund. But at this point in time, is there some aversion that has crept in from the retail fraternity, or is the flow situation still intact?
So I can just say that up until the last week, we've not really seen any moderation in flows. In fact, flows have been actually turning healthy in the space of the last, say, 15 odd days that we've started seeing this correction. And it's applicable across all our funds. I mean, we've seen that as a trend even in the industry, and we've been getting a fair share of that, more than our fair share of that probably in the space of the last few days. So I don't really think this time around the behavior is reasonably different. I mean, it's fortunate that we are seeing a good amount of traction from the domestic investors, and I probably think that this is likely to continue, given that of course markets correction is providing an opportunity. We are now almost back to where we were 1 year back, so it's a fresh opportunity once again to get into the long-term story. And secondly, of course, there's a lack of attractive other assets in the play today. So I think both these factors will probably contribute to keeping up the money flow from the domestic side.
Taher, you handle both the large cap and the mid cap in Motilal Oswal. Now, given that we've seen a sharp correction in the large caps as well as in the mid caps, where you at this point in time you see greater value for a long-term investor?
So yeah, I think, I mean, if one were to just probably look at pure numbers, we, including today, I think probably market would probably be down, say, about 4-5% over the last 12 odd months, of 3 odd percent or probably so. And mid caps, the mid cap index itself is still about 15% higher than last year. So clearly there's a wide differential between the performance of the large cap and the mid cap space. I think a larger part of the pain, even in the recent fall, has come on the large caps. Today, of course, it's a slightly different scenario, but till now it's been more of the large caps which have been bearing the brunt. So I would think we are coming to a stage where there's much more value in the large cap space compared to probably what we have immediately going to see in the mid cap. So I would think the large cap probably makes slightly more sense, and they would probably also evolve as leaders. If the market were to probably reverse, then that will be the sector that'll be the space one would expect to take leadership from.
So given that there is so much of valuation gap between the large caps and the mid caps now, are mid caps more vulnerable to sell off if there is a global risk of which continues?
Yeah, probably it could be the case. I mean, we are seeing a little bit of evidence of that, and maybe you could see a correction in the mid-cap index. You could probably see, of course, there will be variations. You will probably see some stocks stand out, but clearly, I mean, after the large brunt which has been seen by the large caps, mid-caps do tend to become a little more vulnerable in the short run.
Gautam, you manage the Focus 35 fund. Some of your stocks have done really well. They have been re-rated, but over the last fortnight, we have seen quite a bit of damage, price damage, in names like Maruti, HPCL, even Eicher Motors. Are you getting concerned, or is this an opportunity to accumulate some of these stocks?
No, actually, I'm not concerned at all. I think this is more of a healthy correction. So there are two parts to a stock going up. One is the earnings growth, other is the re-rating. So the re-rating bit was a bit too much for a few of our stocks. In fact, we have had to stop buying quite a few of them.
Okay.
So wherever the price is coming back to a comfortable buying zone for us, we're actually very happy buying that. And to add to that, the earlier question about flows, actually in F35 we have been seeing very decent numbers over the last couple of months. And as a house, I think we are pretty much up there in terms of doing the highest ever months of late in terms of run rate, right?
But so just to explain that point, since you said that some of the stocks you had to stop buying and some of the stocks you would look to buy now.
Yeah.
For example, two stocks that really stand out, Maruti and Eicher Motors.
Yeah.
How would you approach them now?
So Maruti, Eicher and Britannia, all three are part of that class where we wouldn't have been able to buy them earlier, given the valuations, given that a lot of PE re-rating was already happening. Less so for Maruti, but much more for Britannia, much more so for Eicher too. So now with the little bit of correction, the little bit of lesser PEs that we are seeing, probably, from an entry perspective, it makes us much more comfortable.
Can you say the same for HDFC Bank as well? Because even that tops your in the Focus 35. Are private banks now in a comfort zone where you think valuations are attractive enough to buy?
So among all the sectors, high quality private banks would probably be the most comfortable sector for us today in terms of bank. They were not uncomfortable even before the fall started happening, so they have actually become even more inexpensive, I would say. And it's also because of fundamental reasons, because if you look at the stress asset formation, most of their competitors will have to focus their energies and their risk capital on handling the stress assets, which will give some room to the likes of HDFC Bank and HDFC to get some high quality market share. So within the entire banking pie, you see it's growing at 8-9%, and the quality part of it is probably growing at a much lesser portion, right? So there are good loans to be given, there are bad loans to be given. So if I look at the good loans market, the share of HDFC Bank will even go higher, is our current hypothesis.
Okay. Talking about banks, it's good you guys brought that up because you had Chanda Kocher speaking at your conference earlier in the day. Taher, you sat through that discussion. What was the key takeaway? Not more so what she said, but what her response to the Q&As were. Because, the stock has lost 30% of its value since the start of the year.
Yeah, so I think, questions essentially revolve around NPA formation, and at least as far as ICICI Bank goes, they've done a fairly commendable job compared to what they were in terms of their situation about a few years ago. So I think there's been a sequential improvement in their performance over the last 8 to 10 quarters on a consistent basis. They are now much more comfortable in terms of where their gross NPL levels are. The restructuring is almost done with. So I think they are now probably also, given the fact that they are in a better position to compete now with other private sector banks, probably especially in the large corporate space, given that they built their CASA in the last few years, which was not the case earlier. So I think from the point of view of cost of funds, they become much more competitive, and they are now in a position to therefore be in the large corporate space, which probably alleviates their pressures as well in terms of future NPL formation. So I think she sounded fairly positive. She struck a fairly positive note across. There were questions around essentially credit growth as to why the growth in the system was so subdued. To which her response essentially was that outside of the banking system, there's a fair amount of credit which is happening in terms of commercial paper, bonds and so on and so forth, which are also contributing another 4-5% to overall credit growth. So I think one can probably argue that this is taking away some share from the banks, but broadly consumer lending still continues at a more robust pace, 16-17%. Their share in the overall system is growing. So from their positioning point of view, it is fairly okay. But the key challenge, of course, is to take up the overall banking credit growth figure faster up and higher up. And for that, her response was essentially that the government will have to take the lead. Yeah. So I think public expenditure, government expenditure, that's something which she was more focused on. And
did she comment on, some of the rising probable NPA issues? Because, now we are seeing companies implode, names like Amtech Auto, and even in the metal space, I mean, Bhushan Steel is the least of the problems. There's so many more that are creeping up now. Are any of the banks starting to get worried about this situation going out of hand as far as NPAs are concerned?
So there was a relevant question in that area, particularly with respect to NPL formations in the commodity space, in steel particularly. So her view was that, at least some of the good number of companies actually from a efficiency standpoint are fairly good in India. So, for them to be able to manage this kind of a scenario of very low prices or beaten down prices should be better. But again, the response to that and the solution to that probably is to, at this stage, start having domestic activity pick up, so that steel consumption domestically at least starts going up, and the companies therefore have a lesser need to actually export or look elsewhere. So beyond the point, protectionism and higher import duties may not help, but again, coming back to the same point that it's the government which needs to start or kickstart rather overall economic activity in India, and that's what probably she was focused on.
Taher, there's quite a bit of dichotomy. We've seen so much FI selling, and here at your conference, I've heard that it's been record FI turnout. What explains that? And is there still hope in India's story? Is the belief that this is still a bull market which is going through correction, or are we now beginning to say that maybe this is something more?
No, I think people are, there's clearly one can see the participation around, and we're probably seeing many more people in individual meeting rooms where I believe they're running to packed investor audiences. But I think, so there is clearly an appetite, and of course people want to reassess the overall situation, given that we've, at least in many ways, if one were to cut out the market and indices and the corrections that we've seen, in many ways as an economy has stood out compared to many other countries. Even our currency for that matter has been relatively robust. So I think investors are still seized about the fact that these could still be very interesting times and opportunities to get into a market which is reasonably healthy from a longer term perspective. I would rather think of it that way than think of it negatively. So I think people are clearly interested in reevaluating the overall scenario, and that's what probably is pulling the crowds here.
Gautam, the other theme that you've been betting on, or especially as a house you are bullish on, is the OMCs, the downstream companies, the HVs of the world. Post the run up in the crude price, or a little bit of bounce back, what's the general view on the OMCs? And now, after the sharp correction in valuations wise stocks like ONGC and all, have you looked at upstream companies as well?
No, we are more focused on the downstream because clearly there's a business re-rating happening, right? Because now the business model is very different, pricing is free. So we expect OMC retail operations, the marketing bit of it, to be hugely profitable. The inherent nature of the business is such that it should be very profitable. Only problem was, the pricing was completely government controlled for a long, long time. So they were never allowed to make the real market returns that they could generate in that part of the business, which has changed, which is changing as we speak. And while the market has reacted to a part of it, but it's still not completely in the price is what we believe. We believe that these are franchises which can make superior returns on capital employed, anywhere up to 20%, and with a GDP-linked growth of maybe 10% in earnings, there is good room in terms of upside for these stocks.
Okay, by the way, just a word on market, because we've seen quite a bit of slide actually now. Axis Bank is down 4%, ICICI Bank is down 3%, Vedanta is down 3%, NMDC is down about 4.6%, Coal India is down about 2.7%, and Bosch is down about 2.6%. Dr. Reddy's, Lupin, Asian Paints are some other big losers. So not turning out to be
post-noon, right?
It's getting worse post-noon, and especially the last hour is not turning out well for the market, Sonia. That's been the problem for this market. The closing has been much weaker than the opening.
Yeah. So I was coming to that point. Up until now, retail sentiment has not been hurt just yet. But the big fear in the market is, what if the retail money starts to get pulled out as well? Is that something that you would worry about?
If you see that the retail money, whatever savings gets generated in the country, I think the more structural shift is from real estate and gold to investments in financial assets. So that part should continue, because that's a much more fundamentally driven thing, much more structural thing that's happening right now. And that's also to do with the lack of returns that we are seeing in real estate and gold. So that part of the story is well maintained. But yeah, you're right. From a fear factor perspective, it could momentarily slow down in the market.
So if you had to give us some indication of how much your funds could perhaps grow, say in the next 1 to 2 years, what kind of average CAGR are you looking at? I mean, so far it's been phenomenal, 30 to 60%, but what kind of returns can we expect in the next couple of years?
So I don't know if we can even comment on return expectations, but I can talk about earnings growth, right? So when we construct a portfolio, our earnings growth expectations from that portfolio is 20 to 25%. Now, you would say that how is it possible when the index earnings is not growing? That's been the case in the past, and that's probably because, you have to just do the right job of choosing those 15 to 20 stocks out of maybe 5,000 plus listed stocks in the universe. So that is essentially our job, and through that we're trying to deliver 20-25% earnings growth. So if that's the earnings growth, and over the long term, markets should deliver as much as earnings delivery happens.
Okay. I didn't hear your earnings expectations. I think the one session just got over, so it's very loud behind. What did you say? It was
actually, I was happier that you didn't hear it.
How much have you scaled it down to?
20 to 25% is the range that we target for at the portfolio level.
Okay.
At the portfolio level.
Which is not bad.
Which is what is the driver for markets, we believe, in the long term.
Taher, you look at the midcap fund as well. You've been holding some of the blue chips of the blue chips, the Amara Rajas of the world, and Container Corp, and in the pharma you hold some of the midcap pharma stocks as well in the pharma. Generally, what's the sense in the midcaps? Where do you think the earnings is still showing a decency, and there will be earnings growth? And which are the sectors or stocks that you think are still giving a lot of value from the midcap space, from the midcap basket?
So I think mid-caps, at least the portfolio has been built completely bottom-up, like it is even in case of the large cap, and more so probably even in the mid-cap space. So I think the key, the pockets of earnings that we are seeing which are durable in nature are, say, out of mid-cap pharma, IT, mid-sized IT companies. I think we see decent amount of growth out of NBFCs. In fact, if you look at the Focus 30 mid-cap fund, then we don't have any public sector banks or private sector
You
banks.
hold Bajaj Finance, right?
We hold our portfolio entirely comprises of, yes, Bajaj Finance is there. So we've got only NBFCs. We've got Bajaj Finance, Repco Home, and Sundaram Finance, and so on and so forth. So I think NBFCs as a class is making much more sense to us in that particular segment, particularly the growth segments of the financial services space. So that's where the bias is. There we can probably still think of a 15 to 20% growth even in a challenging growth environment. I think there are a few pockets of growth which are there in individual areas like things like logistic companies or, like as I mentioned, mid-sized IT companies. Those are areas which are rewarding as well. To my mind, I think they can still grow at about 20-odd%. So even in a depressed economic conditions, that's what we will probably do.
Okay, what about real estate? Have you looked at that sector? Is there any value now emerging in the real estate stocks?
We don't have any direct exposure to any of the real estate stocks, nor have we looked at it. We've not found any individual bottom-up opportunities out there which are, shielded from the regular concerns which surround the whole real estate space. So we have decided to give that sector a skip.
Okay, Gautam, nothing on pharma. I mean, we've seen a lot of correction in mid-cap names now. Strides, Arcolab, DVs, all these stocks are correcting. Good buying opportunity, or do you think too expensive even at current valuations?
Well, pharma, you'd really have to go from stock to stock. I won't talk about it as a sector as such.
Okay.
But if you see, there are this set of stocks, pharma stocks, which are seeing very high rates of approvals coming in from the US FDA, right? So which is a phenomena which was absent last year. So they are seeing the spurt of approvals coming in again, which is a source of re-rating, which should happen in few of these stocks. And these are the stocks which typically we also like, which have a very strong pipeline of ANDAs filed with the US FDA. So these are the kind of stocks which are essentially looking good.
All right, gentlemen, we would have loved to chat some more, but as you can see, there's a lot of noise in the background. So what we're going to do is thank you guys and hope you have a great conference. We'll touch base with you again once the conference gets over. That's the word coming in from the minds behind some of the best performing funds, the Motilal Focus 35 Fund, which has generated almost 20 to 30% return over the last couple of years. And of course, as they point out, the time to invest in the markets continues to be at this point. With that, we'll hand it over back to the studio. Not looking very good for the markets, but over to you guys in the studio.
Yes, Sonia, there seems to be a lot of buzz where you are, but right now you're sitting here. It's quite gloomy. So we're at the low point of the day. The Nifty stands at 7570. It's a cut of 85 points. That's a fall of more than 1%, while the Sensex 2 has slipped close to about 250 points. The selling pressure has accelerated since 2 o'clock. So since then, the Nifty has fallen close to about 70-odd points, and the banks have seriously underperformed from that period. So the Bank Nifty, which earlier was holding relatively steadfast, is now down close to about 2-odd%, and Midcaps too have extended their fall, taking the advanced decline ratio at 1 stock in the green for 4 on the losing side. And this comes at a time when European markets are still holding up in the green. Yes, they've come off nearly 1% from the day's high, but Europe should come up. It's still up close to about 1/3 of a percentage point for the key indices. So markets not looking good, and across the board you can see some big cuts. So NMDC is now down 4.5%. Banking names like Axis Bank, ICICI Bank are looking weak. Other commodity linked names like Vedanta, Hindalco are bleeding quite a bit. You've got a Lupin, which is now around that 1800 marks. That too has slipped nearly 3%. So we'll slip into a very short break. As we do that, here